Hello guys, and glad to have you on board again. Today we're going to do investing stuff, so long-term, mid-term investment in here, how to strategically use smart investment techniques to optimize your trading behaviors in here stock indices. This is the easiest way to explain that, but you can basically use the method to any other thing you do. You will see a lot of similarities coming from other things, like eventually if you want to invest into some specific sectors, either this is commodities or whatever, or if you want to have a totally broad-based type of investment, like you want to spread out through metals, I don't know, agricultural products, all of those things. So it's just about sectorial analysis, spreading out the money into some multiple areas, because that's what smart investing is all about, first of all. And before going any further, we're just going to make a quick assessment in here. When I say smart money investment, okay, a big warning in here is that smart money investment techniques doesn't mean a trade will be successful. And sometimes we oppose smart money behaviors versus dumb money behaviors. And you need to understand that that doesn't mean dumb money will lose money and smart money will make money. And actually, if we were dealing with a trade-to-trade basis, I would even say that the dumb money techniques are sometimes more efficient when it comes to a single trade opportunity. Because dumb money is much more risk-taking than the smart money and much more randomly based outcome. But randomly based doesn't mean losing money. It just means that as there is less risk-taking, as there is less risk management, the more the experience gets repeated through time, the lesser the reward will be. But on a single trade basis, tend to be like the gains are much more staggeringly great for dumb money decisions than they are for smart money one. But what I'm trying to teach you out there is not just how to make a good call. It's just how to make lots of calls and be rewarded for most of them in a positive general outcome. So if you fear of going wrong, then just don't do it, because obviously some things will go wrong. And I'll go straightforward with you guys. I've been totally wrong with some asset investments I made in a previous investment cycle. So yeah, I'm not going to get 100% chances of things that do right. I did catch some very nice trade indeed, of course, but I mean, you never know what's going to happen. Remember all the uncertainty biases stuff and all of that thing. It's just that we're going to apply the same old rules in here with additional risk management structures I'll teach you out there. Because they are absolutely necessary in a broader market perspective, dealing with much longer cycles, the one we've talked about. Okay, so things that generally tend from microcycle stuff, which is generally between 20 to 35 years, okay, 20 to 30 years, which is multiple tiny economic cycles in there, or just as an economic cycle perspective, which is just generally between 6 to 12 years. Okay, so we'll see all about it in these perspectives. So which point are we probably into, because we don't know for sure. We would definitely be looking for a potential second entry in the economic cycle. Remember that an economic cycle is followed by 5 steps. Okay, the first step is buying the crisis. Crisis means opportunity, means normally smart money use the crisis behavior to gather some assets. It's basically in crisis time, lots of people are owning stocks, prices are falling, people need money, so they're selling their stocks, and some other people who have money are willing to buy them. Okay, pure and simply. So yeah, crisis means changing, means opportunities for someone, and you're generally taking the opportunity of someone else's lesser rational decisions or whatever. It's just, anyway, things are changing, things are moving, and in a market perspective, as we look for investment, we're going to look for someone else to sell this thing at cheap prices. That's what we look for as an opportunity to buy the crisis bottom. So this is what I think has been done with the coronavirus. We've had the validation so far, because as we get into a trade, you just don't know. You need to wait for validation. So far, the early reactions we've had totally validating that we've made a bottom. But I mean, that still raises one question. We're dealing with unprecedented territory. I mean, we've never closed economies for more than 2 months. So we don't know yet what type of rippling second effects could eventually show up. And we cannot make sure that at that point, what we're dealing with isn't something bigger to the downside. So we're going to make this assessment first. trying to rise the probabilities of us going to more lower territories. Basically, what we've had was just the early beginning of something much bigger to the downside. So how do we risk manage this probability? How do we adjust from that? And considering we are fine, okay, we're going to move ahead of how do we risk manage a second investment into the economic cycle? How do we manage the previous entries going along with the next ones? And how do we define the probabilities for this economic cycle to take each and every one of the possible shapes that I'm going to explain later on? Let's move to the charts because I'm going to need some technical stuff before moving any further. Okay, so first things first is what you have in front of you guys is sectorial analysis of the S&P 500 composition, which is basically all of the major sectorial assets in the SPX. The big question in here, and the only thing we're going to be doing first, is getting right into the SPX itself before making this sectorial analysis. Okay, so SPX. All right, and first things first, we're going to study the long-term rewards. Okay, you know that the economy is breathing in and out at multiple cycles, multiple rates. Okay, so they are longer-term cycles, shorter-term cycles, whatever. What we're dealing with in here is not even assessing inflation and growth to support prices structure. We'll just figure out that there are some cycles. Okay, the first one, as you can see, is that we were oscillating, kind of a ranging structure, whatever. I don't have enough history to go beyond, but this is the beginning of an economic cycle in here, a macro cycle. Okay, this one started 1971, ranged a bit, accumulated, broke up, trended, and gone excessive with the 2000 bubble. Okay, that's what it goes. We've been using parabolic scheming structures in here because we need that. Okay, so starting 1974 or 1971, I would say 74 because we've made low below. So 1974 is our low point. Okay, reaching out to new highs, accumulating, breaking, all of the usual stuff. So we've gone trending territory in here and bullish territory for the latest 5 years of this economic cycle after an area of quite mitigated rewards. Okay, so you can see 3 cycles, 1, 2, 3, 4, 5 wave. Okay, so 1, 2, 3 cycle. Okay. And then comes this, oh, same old thing that looks like 1971 to 74. Okay, so that's same thing, ranging again, and therefore we go there. So we would say, all right, out of the global perspective, feels like this is a wave 3, very extended, and we might be going for a shorter economic cycle out there, as this one was the extended one of a much broader, bigger event cycle, something that generally lasts for 50 to 60 years. So, oh yes, there are cycles within cycles and cycles within cycles and so on. Yes, that's exactly what we're talking about. But anyway, the global structure is what we care about. It's always 3 sets of waves, okay, when it's rising, and stock market is supposed to rise. But starting now, we just have a clue about multiple things. We know that the economic cycle we're looking for is probably going to last a less longer than this one. This one has been lasting for 26 years. 27 actually, because 2001 in the market top. Okay, so yeah, 26 years. Now this one started 2008. Okay, so we are 12 years in, soon to come 13. Okay, so sooner or later, it actually started 2009, not 2008. So 2009, and we're 2020, so 11 years in, out of a maximum possibility of probably something like 16 to 17 years, because it's definitely not going to be as long as the previous one, as this one was the extended structure. So this is accumulation, breakout, pullback, final excess. So we would be at the end of a macro cycle, but still bullish, god damn it, because there are normally quite some sets of waves to come down the road. So that would be first investment technique, the pullback, the rising, the accumulation, breakout, pullback, final excess. Oh geez, we could be at the end of something. Oh man, that's exactly what we just talked about, okay? What we're experiencing right now is an expanding wedge structure, which means, oh shit, Sherlock, normally we don't definitely break out of these structures, or we can, but not immediately. We generally stand still for a bit below the structures to actually break. So What that gives us as an information is that either this is what's going to come, okay, or we never get out of this structure, which means as they are expanding wage, we just buy ourselves some time to expand the possibilities and we never break out of them, okay? And in that perspective, we're locked in there for quite a long time. Still, I'll let you assess how brutal this trend line already is in terms of strength and amplitude. It's as wide as the entire things we've known so far. So starting from 2009 bottom, we've got one thing to say at that point. Either we're just going to, at best, keep the pace, which means we can rise. Yes, we definitely can, but we're going to have to save some time, digest the crisis before moving on. So limited upside potential, and we're just basically going to grind our way through and across this trend line without being able to break it up, okay? Second option, much more pessimistic, is, oh man, we're wrong. We're already terminating this big thing for 60 years and we're just about to make the end. And in that perspective, going down this area, okay, and doing the same thing on the opposite direction, okay? So that gives us actually 4 options. The first one is we grind our way up, slowly but steadily, limited growth, but still being bearish is absolutely stupid out there. It's just we're going to try overperforming the indices by looking at sectorial analysis, okay? This is why I was showing sectors earlier. This is one of the ways we can overperform the market, or in the case of a downside moving market, consolidating probably down to these previous market tops and stuff like that. That means yes, retracing SPX fairly lower. But if that's the case, still in here quite some opportunities can be made, because out there we do have ranges and we can manage overperforming the market, looking for sectors that can provide opportunities, stock pick, and all of those things, because of course market cannot remain bearish forever. So if we terminated something, that means we will be bearish for probably 5 to 6 years, something longer than what we're experiencing in those things. Generally means we're going to get something like that. So a minimum 6 to 7 years of bearishness to come. But bearishness in the stock market doesn't mean pain in the real economy. That just means contraction stuff, okay? Less money available, credit destruction, means people saving money, which is not necessarily the end of the world. It's just like, yeah, it's not going to be as great as possible as people thought it was. So in that perspective, yes, there would be a lot more pain down the road. But yeah, I don't really think that's the most probable. We're just going to assess those things later on. The worst case scenario is just, okay, collapse, whatever, but I think it's very less likely going to happen. Because of course, remember that stock indices in here are also pricing in inflation, okay, and GDP increasing, okay, so they're linked to GDP, and the GDP we have right now is nothing compared to back then. So we cannot go into those territories. It's just not possible. So I think this option simply actually isn't possible due to structural things. This one possible, but very pessimistic. This one very likely. I think this is the neutral option, okay, so if we figure this one out, this would be the neutral option, keeping the pace of what we've previously done, but not with acceleration rates, okay, just standing still, okay, oscillating there. That would be pretty pessimistic, but still possible. We're dealing with unprecedented territory, so like we said, if you flush this option out, there is seriously a problem. Third option will be, oh man, we can go way faster than that. We've gone stupid previously. Why the fuck wouldn't we be doing this? I think we definitely have very mature overall economic cycle, 60 years stuff that has been going on for so long. So I will pretty much go for optimistic, yes, but not too much, okay? So one of my 2 favorites is either this one or this one. I'm definitely betting on one of them, okay? So that's, once again, a choice. Like I said, smart money isn't about making the right call. Smart money is about optimizing your choices. So here's my choice. You do whatever you want. I gave you the 3 possible options. There's also an in-between in which we just stand the fuck out there with huge volatility, which I say is possible. But anyway, if that's really what's about to come, it's going to be a mix of those 2 in order to things, which means we're going to try optimizing reward by amplifying and overperforming stock indices. Either one way to the upside and then to the downside and so on. We're just going to try overperforming the market using the most volatile components. So in this case, okay, very less likely going to happen, but could. If that's what's about to come, then it's just better trading. Just don't have any mindset and just trade high beta stocks. When it goes up, trade the high beta stocks to the upside. When it goes down, trade the high beta stocks to the downside. That's really the most stupid thing. And it's basically creating bubble, bursting them, creating bubble, bursting them, and so on. So that's one of the possibilities that things could eventually roll out. Okay, this one, yeah, pretty pessimistic, quite neutral, and very optimistic. Okay, so multiple options, pick the one you think are the most favorable structures. I would be very dumb to give you a 100% reliable answer. I gave you mine. I favor this scenario right now, and until further notice, I still think this one is probable, but requires a lot of risk-taking. Therefore, absolutely a Trump presidency out there with huge amounts of cash spent. Like, it has to go way further than what he done for the latest years, which is just unprecedented territory all by itself. So can we go even further? Of course, because there's never limitation when it comes to do stupid stuff. But yeah, it definitely requires Trump to be reelected, because I doubt Democratic candidates will manage to do even worse than what Trump did. But that's the thing. So I'm going for this, as right now I think I'm still favoring Biden to be the next elected president. But still, that's a big if. So risk management must be done. I have my plan, I have my options, I've got my risk management structure. I'm going to need signals to either validate or invalidate. So as long as the US election isn't on, there's still a huge level of uncertainty, because the next presidency, even though it doesn't necessarily imply 100% probability to behave as expected, seriously orientates the plan and scenario. So if you already know the next president, please tell me, because I don't. So this is how it goes. I go for my probabilities. I'm following the polling systems, and whatever people will say, man, they got it wrong on the last election, they would definitely do it as well in here. I mean, who knows? In my personal experience of life, statistics works pretty well. It's just like sometimes they fail and people make a big shit out of it. So I'll follow the stats, and if I'm wrong, I'll readjust, of course, as expected. So if Biden's president, I think the free money stuff, whatever, is still going to be there for a little while, but the way money is going to be spent and the budget is certainly not going to be used as financing big corporations and stuff like that, which would probably collapse most of the bubbles we've experienced. But still, that doesn't mean the market will collapse. I think it's just going to be compensation, moving around the money, okay, with crashes and dumps and pumps and whatever. But I think these things was the Trump era. So I think this is soon to be over, just calming down, eventually popping the tech bubble, and then or just deflating them. That doesn't mean everything will have to crash immediately into a bursting, bloody bath or whatever. It just means downside probabilities to the future, where some other defensive sectors might eventually take over. So this is where we get in, okay? As you made your choice and as you orientated your thing, if you think Trump is going to be down the corner and the massive gains are down the corner, you're just going to orientate to our more offensive sectors. Okay, really all about a choice out there. This is not where the devil's hidden. So let me put XLP back in this thing and let's make an assessment. Okay, what we care about in here is not, without going into details, too much details, you can definitely dig a lot deeper into this. We're just going to split this thing into two territories. Okay, so defensive. Okay, we can see that this is very oscillating. Okay, defensive, defensive, and defensive. Okay, which is, from what we've experienced for this economic cycle starting 2009, offensive, offensive, very, very offensive. By the way, this one is just like we put two arrows. Okay, offensive, okay, and very, very offensive. Okay, so you've got basically 3 packs, but let's consider 2 packs. Okay, so 1, 2, 3, 4 defensive sectors versus 1, 2, 3, 4 offensive sectors. Some are being very offensive, of course. So here we go. We do have profiles. So which one of the previous plans did you pick considers which next one you're going to get. Okay, so we'll definitely look at the overall trending in the cycle, and the second stuff we do is the same analysis in a shorter time frame the post-crisis recovery. So we just zoom in into the lower time frame and we need to figure out how things rebounded. So you take the bottom from the crisis and you have a look at what this looked like. Okay, so this as a reference and how did we behave. Consumer staples, which were supposed to be a defensive sectors, has managed its way right to historical highs while making a slightly lower low point. So it feels like it's totally behaved like the global market sentiment, the S&P 500. Materials, oh, they've been surging to historical highs for a defensive sector. That's pretty surprising because of course it has been totally slashed during the crash. So slashed but huge recovery. Oh, very interesting. Okay, of course tech sector barely retraced, didn't make new low, and absolutely staggeringly stupid rise since then. Okay, on the opposite for financials, oh, huge lows and didn't really manage to catch up on this thing, so very not attractive at the moment. Industrials, huge new lows and still hasn't recovered, still dealing with a possible third range boundary trade out there. Okay, so healthcare made barely new lows out of 2017, but made new lows over the latest few years. But I would call that a median dip and barely managed to make new historical highs. So this one was growth and is losing strength. So I wouldn't call for healthcare as a participant for next economic cycle. Just be standing out there and waiting for further stuff. But if we go for a huge trending cycle or whatever, I think this one might be the thing to go, not necessarily tech, but we'll see. We'll talk about that in a very growth perspective. Utilities, okay, made seriously new lows and still very much lagging behind, like a hell lagging behind. And consumers discretionary made new lows and serious recovery until then, thanks to Apple, of course. This is really all about Apple's bubble. So the rest of the consumers discretionary sector, very not that attractive. It's just like take Apple out of this and it's definitely a totally different game. Okay, so here's what we deal with. Okay, we see that some sectors are behaving as we expect them to. Okay, the huge growth sectors are being overperforming, but some others don't. Healthcare is not part of the huge recovery. They still have managed their way back to historical highs, but not that fancy. So yeah, it is acting more like a range, and we're going to have to figure out what's coming out of this. Of course, tech is definitely looking like a bubble. It's crazy fucking parabolically dangerous, but it's just on the verge to prove that it reacted as people expected it to be, which means they got even one step further into stupid trading. Okay, and all other sectors have basically behaved the way we thought they would. The defensive sectors, I note the consumer staples have managed their way up where others didn't. Okay, these ones didn't. Sorry, consumer staple is more of a neutral. Okay, so the defensive sectors are there. So I just got it wrong. And utilities and financials. Okay, so out of the defensive sectors, there's just materials has managed its way up. So this one, very interesting. Okay, because that's a defensive sector that's showing quite some potential in terms of reactions. All others, we can definitely say that in terms of strength, utilities is the one that lags the most with financial, where industrials and materials are somehow managing their way quite better than the others. Okay, so we manage relative strengths out of defensive sectors. So my personal assessment, remember that the three possibilities over the SPX, I stand for the slightly bullish one, okay? So more of an arbitrage, try to overperform indices trading by sectorial risk-taking, which is one of many ways you could do it, okay? And in that perspective, here's how I would do, okay? I would personally opt for the trending defensive sectors, so more industrials and materials to be used into my strategy, because I think these guys can overperform, and that's a classical stuff of late stage trending. Okay, we make a huge pullback and generally the defensive sectors are gaining to catch up on the strength, where normally the offensive sectors just hold on because people get to buy them real fast. These are the ones that creates the recovery, but generally the late stage come from the laggers. Okay, so going from this perspective, I think materials and industrials are the values in which we want to put some overweighting perspectives if we want to get into a lagging, late stage, very boring economic cycle, but still bullish, okay? Option number 2, going for the crazy parabolic shit. In that perspective, I think definitely these two will be part of the game, which means that's the reason why I favor these, because both case scenarios, they will probably make money. In this perspective, the crazy bullish, the problem is that financials and utilities will probably lose money, which means they will be so less attractive regarding to the huge growth and risk-taking of the rest of the factors and markets that people will just get the hell out of them because they'll feel so boring. And in that perspective, the huge crash that will come out of this bubble will get to absolutely bring everyone into those defensive values, okay? So in that perspective, utilities and financials will be the big thing to buy out of the next major crisis, okay? But not to buy for the next economic cycle if we go for a crazy parabolic shake. In that perspective, what's going to be bought? Of course, the tech bubble will go one step further beyond the stupid levels. It will be the same old guys one over again, but as the pace will slow down, because these things are totally unsustainable for more than just a couple years, the problem is that we're going to have to manage to hold valuation when these things will crash. And the problem is that when these things will start losing the momentum before crashing, or even starting to crash and making dead cat bounces and stuff like that, we're going to need something to compensate. Generally, what we use in this perspective is those more defensive sectors that are catching up on the lagging structures. So I'm looking at healthcare because I think it could be interesting, but we're still needing more information to actually process this one of whether or not being a growth factor, but could be, just like we said, tech has been leading. Eventually, healthcare could be doing its own bubble thing once again. Okay, after deflating some of the healthcare bubble of the past years, we could eventually consider making a new one, which is possible. Different economic cycle means different bubbles can be at play, okay? So we'll see. I will go for materials right now. This is definitely one of the sectors I like the most. If there is a pullback, I think materials could definitely be along the pullbackers, and this is what I'd like to catch. Okay, so now let's get to the structure. The thing is that in order to get that, you need to see a pullback, okay? Into an economic cycle, you take the global market behavior and you should see something, which means zoom out the monthly chart. Do you see something pullbacking out there? I just see absolutely nothing. So we need to see an economic cycle, subdivisions, just like we did previously. Okay, going up, made a subdivision, going up, subdivision. We need to build a cycle. So if we have just made something and terminated it with this wedge structure, whatever, there are 5 subsets of waves to come. Though we would have the first one, we would need to build a second, third, fourth, and fifth. And in that perspective, we never break the one we've talked about. We just ride our way through it into 5 subsets of wave, probably 5 to 6 years at best for this economic cycle. And in this perspective, that's what I'm dealing with, okay? That's what I'm heading for. So what I'm waiting for is this pullback. Is this a pullback? No, fuck no, not yet. So either this is just a short-term pullback and we're going to keep on grinding until we get the thing, okay? But I'm waiting for this thing. So I'm waiting for something that is going to be visible into the weekly, monthly chart. What we just had recently, yeah, it's barely scratching the surface. So either this is the beginning of something slightly bigger, which I will get to care about, or it's already ended, and if that's the case, then yeah, we'll make historical highs, and the further down the road we'll get this opportunity, okay? So I'm preparing you for this nowadays, just so we do it with anticipation. So we have to go lower because it has to be visible into larger time frames, okay? Like I said, the problem is that I think the election is the turning point because that's one of the major and impactful factor between one way or another. And it mostly depends, yes, who's going to be the next president? Of course, if you want a bubble, you definitely want to have Trump because it's definitely the bubble inflator type of guy, where on the opposite hand, a much cooler approach, more rational and stuff like that, it's much more going to be the progressive system of Democratic candidates, which is still going to support growth, I bet, but just a far less crazy, stupid, motherfucking bubblish growth, okay? So we'll see all about it. First of all, I think waiting for the elections to actually be proven right or wrong feels rational, so here we go to conclusion, how to actually process all these informations at once and get to a more rational decision-making process. All right, the thing here is that you need to understand that there are a key turning point, which is the US election. That's actually the turning point for everyone, but it's not just because of new president. It's just because it's going to orientate smart money decisions on what they will actually be dealing with at the next economic cycle. There is two types of decisions. If you already bought the low points and if you are getting into a first investment, you basically missed the shot with COVID and you're just going to enter out of nowhere. Okay, so two options will have totally different risk management at that point, because one of them will already have made gains, profit took, and will reinvest some of the previous gains with a little premium, where the other ones are just totally naked and we're going to have to jump in the water. Though very dangerous things, because remember that if we do favor two scenarios out of the three, there's still a third one, which is the less optimistic, quite pessimistic one actually, in which we go back to the bearish area of the wedge and grind all the way down until something better happens. Even though less probable doesn't mean can't happen. So you need to risk manage according to this. If you're getting bulk in, and if you just basically get yourself to buy right now, you need to understand that the S&P 500 could slip below 1,500, which would make significant changes to your portfolio management. If you just bought it over 3,000, you're going to lose more than half the value of your assets, which is absolutely staggeringly impossible for a manager, okay? And going into a buy and hold into this thing just makes things even worse. And saying, all right, I bought 3,300, what the heck? Anyway, it's going to go higher 10 years from now. Well, if you understood what I said, we might be on the end of a 60-year major economic cycle, which means if we go deflationary out there, we can go much lower than that. So just don't give a fuck. If you want to lose 80% of your investment and just barely put all your savings locked down for 30 years, then good to you. But once again, it might take more than 30 years to actually eventually catch up on these prices. So if you're ready for it, I think that's a very dumb decision-making process, because anyway, that's not how it goes, okay? So never be 100% at that point, because we need confirmations first. So if you get in right now without initial investment, 50% of the capital is definitely a tipping top limit. Don't go anywhere beyond that. So you have 50% of your money to invest. Still great, okay? But keep some cash just in case, because you're going to invest it at the second stage when we validate this second entry, which means building a dip and retracing to new historical highs. And in that perspective, you'll say, okay, we do have a bullish market down the road, though I'm going to use my 50 remaining percent to either reinforce some stocks or whatever and orientate the portfolio post-validation. Are we really going for this thing, or are we going for this thing? We're going to have to wait for those informations, and therefore you're going to need to have cash to orientate portfolio decisions later on, okay? So no more than 50%, otherwise you go into betting territory and taking heavy amounts of risk, okay? You might eventually make more money if you're successful on picking the right track, but you might lose a shit ton of money if you end up being wrong, and this is not how it works. The higher the emotional intensity, the higher the dumb decisions will follow. So not going down this road. For those who previously invested, that depends on how much you invested in the first round. Normally, people invested between 30 and 50%. That depended on how aggressive you were. I personally were going for 50% initially, and I decided to lower to 30% as we were on lockdown and whatever. So historical condition, maybe afterwards I could say I was dumb not to follow the initial plan, but I mean anyway. So I decided 30% investment into the bottom. Half of it has been taken down as profit taking, so gains, okay, that's fine. Most of the prices of the asset prices right now are more than 2 times the entry prices, so I still have lots of gains in here in this market and gains that I took away cash. So I'm less than 15% invested today. So I want to go right up to 50% as well. So the thing is that I'm going to put all the money I have back in the market. I have pulled back, so all the profit takings I've made, I'm going to pull them back in the market, which is nearly going to pay for 40% investment, and I'm going to have to add up a 10% cash investment. So my personal assessment is that I'm going to put the money back, the gains I've made, I'm going to put them back, and I'm going to add a little bit of a premium from my pockets. So this is how it's going to be, of course, investing in here, but I'm still going to be 50% cash in here as well, waiting for either confirmation or eventually even invalidation, because the thing is in here, if we were to invalidate, go right down the bottom and push even further, I'm probably going to suffer some losses. But the difference is that I'm going to take some tiny losses that will still make me and allow me to be mostly cash and available for the much bigger crisis, which is going to be, once again, an opportunity for those who are smart enough to be liquid at that point. So it's more about assessing the probabilities, and the 50% liquid after the second entry isn't just being too cautious and stuff like that. It's just that half of this money, not to say eventually more than that, will be reinvested as we validate. Okay, you need to understand that if you gamble saying I know what's coming, you just fucking gambling. That's not how things works. Okay, so I think that's an appropriate risk management for these second boundaries. 50% investment, either you're a raw investors just getting to put your first foot in the water, 50%, anything more than that is too dangerous. Wait for validations first and then orientations toward the election. Then second message in here is, if you want to buy this pullback, just make sure it's visible into the monthly chart, which is definitely not the case right now. So wait for significant pullbacks. Just to give you a glimpse of information, generally the second wave comes out of a 20% pullback. We generally reach out to bear market territory, very tiny amount of time. So the second wave is generally rapid, though you need to be reactive. And if you want to overperform the market, looking for some specific stock areas, my personal favorite, as I'm going for this one, is going to be the defensive sectors that looks like strong reaction to the crisis. Okay, I'm going to overperform these things, industrials and materials, but of course that depends on the signals I'll get out there. Okay, then you look at the sectorial indices and you look for good patterns on assets that might be worth it. Okay, you're not looking at catching the bottom, you're definitely looking at catching third range boundary type of stuff out there. Okay, or accumulation trades. These are the patterns you look for into positioning yourself into those stocks. Okay, definitely make sure that you just don't buy two indices or into two sectors. That still means you need to have a few growth things just in case we go for the parabolic shit, though I have Teslas and stuff like that for that. Okay, so I have a few offensive sectors, but just my personal assessment for this slow growth thing is going to be 70% defensive, in which most of these 70% are going to be both industrials and materials, and the rest being 30% into some more offensive sectors, which were going to be healthcare for me and technology. The consumer staples eventually, but I think it's just going to be trading just like the S&P 500. So not overperforming, not underperforming, and therefore not what I'm looking for. The consumer discretionary, I think, is led by Apple, which is a very dangerous stuff for me because I'm selling Apple for 10 years. So I think Apple's out the game. I might be wrong, and until I am not, I'm definitely not getting into consumer discretionary. Okay, so that's what this is about. The sectors I'll favor: two growth sectors, two defensive sectors, waiting for confirmations before putting in a bit more money in there, because I can eventually just be totally wrong, and if I end up being, then I definitely need cash to readjust. Okay, that's what the message is out there. Readjusting if necessary. Don't think you're right, don't go too bold, but go in. If there are some pullbacks and opportunities, if we ever reach out 20% drawdowns from the market top into other indices, if you see the pullback in the monthly chart, this is where you want to go in. Okay, that being said, I wish you guys a pleasant day. Don't forget to stock pick. Okay, if you're really wanting to go bulk, you can eventually consider ETF, sectorial ETF, to do just bulk buying, whatever. I think that's fine, but just make sure to properly weight those things, and more importantly, if you put 100% capital in there, you're just making absolute stupid decisions. Okay, that being said, wish you guys a pleasant day and a pleasant investment if it eventually shows up. But if it doesn't, if we're just in a stupid short-term pullback that just barely means anything, then wait for the next month. We'll go higher and then we'll have that pullback. But if you think we're not going to get one, you're definitely having some problems out there. Okay, there's going to get one. Just be patient enough to wait for it. Guys, later.